Imagine you are running a business where your customers almost never leave you, where the service you provide is not a luxury. It is a legal requirement for restaurants, hospitals, schools, and warehouses, where the average customer has been with you for years and renews their contract automatically. That is what it looks like to be in professional pest control. And one company has built that business into the largest operation of its kind in the world.
It sounds almost boring, Hudson, but the market does not find it boring at all. Rollins Incorporated trades at 50 times trailing earnings, a premium you typically associate with the fastest-growing software companies, not a pest extermination business.
And here is the tension right now. Rollins just reported Q1 2026 results that look genuinely mixed. Revenue of $906 million came in ahead of the analyst estimate of $895 million. But GAAP earnings per share of 22 cents missed the 23-cent estimate by 1 penny. The stock has drifted down from its highs, and some of the largest insider sales in company history are happening simultaneously.
We are talking about over $1,140 million in share sales by the Rollins Family Voting Trust over the past 6 months. The founding family is liquidating a significant position, whether that is disciplined estate planning or a signal about where they think the stock is headed, is one of the central questions hanging over this name right now.
Today, we are doing a complete deep dive on Rollins, the business model, the financials, what Wall Street analysts think, the bull case, the bear case, and what the options market is telling us. We have a lot to cover. Let us get into it. Let us set the stage. Rollins Incorporated operates through a portfolio of more than 60 pest control brands. The flagship is Orkin, one of the most recognizable service brands in North America, with a history stretching back over a century. Rollins serves more than 3 million customers across approximately 90 countries.
The business is organized around 3 service lines. Residential pest control is roughly 42% of revenue. Homeowners paying for quarterly or monthly protection against ants, roaches, spiders, and rodents. Commercial pest control is another 42%, covering restaurants, healthcare facilities, warehouses, and government buildings. And termite and ancillary services, both treatment and ongoing protection plans, make up the remaining 16%.
The real story here is the recurring revenue model. Approximately 80% of Rollins' revenue comes from contractual subscription-style agreements. Customers sign annual or multi-year service contracts and then simply receive periodic service visits. They pay whether or not there is a visible pest problem because prevention is the product. The renewal rate across the portfolio runs above 80%.
That renewal rate is the key to understanding the Rollins margin profile. Once a route is established and a customer retained, each incremental service visit generates almost pure contribution margin. Route density, packing more service stops into fewer technician hours per geographic area, is exactly how Rollins generates its operating margin advantage over smaller regional operators who simply cannot spread their fixed costs over enough stops.
Rollins also runs an exceptionally active acquisition program. They have been rolling up regional pest control operators for decades, buying smaller local brands, integrating them onto the Orkin or Home Team platform, and using those acquisitions to fill geographic density gaps. M&A has contributed roughly 3 to 4% of the 10% annual revenue growth in recent years. It is a flywheel: bigger scale, better route density, better margins, more capital to do more deals.
The total U.S. pest control market is roughly $22 billion and growing 5 to 6% annually. Pest pressure does not take recessions off. Termites, bedbugs, and cockroaches do not care about GDP. The structural tailwinds of urbanization, climate-driven range expansion of invasive species, and tightening regulatory requirements for commercial food service operators make this a genuinely durable, non-cyclical growth market. That is what justifies the premium multiple, in theory.
And at the helm of this operation is someone who came up entirely through the operational side of the business, not the finance side. Jerry Gahlhoff became CEO of Rollins on January 1st, 2022, making him the first person outside the founding Rollins family to hold the position in company history. He joined Rollins back in 2001 through the acquisition of Home Team Pest Defense, where he had been a senior executive, and spent over 2 decades working his way through operational roles before ascending to the top job.
He ran Western Pest Services, then Home Team Pest Defense, became Chief Operating Officer in 2020, and CEO 2 years later. His background is entirely operational: route economics, technician productivity metrics, customer retention levers, and acquisition integration. The Street's primary concern is whether he can sustain organic revenue growth above 5% as Rollins grows larger, and the law of large numbers makes each incremental percentage point of growth harder to squeeze out. Investors also watch his acquisition integration track record carefully, since pest control deal multiples have risen sharply, and the market wants to see acquired capital earning its keep.
Let me dig into the financials. Rollins is trading at $55 a share, giving it a market capitalization of approximately $26.5 billion. That puts the trailing PE ratio at just over 50 times. For context, that is a multiple you typically see on high-growth software names, not a service company whose primary equipment is a spray tank and a truck.
The multiples are rich across the board. Price to sales is 7 times trailing revenue. Price to book is 19 times. EV to EBITDA is close to 38 times. Every one of those ratios reflects a market that is paying a significant premium for the predictability and recurring nature of Rollins' earnings. The question is always whether those earnings deserve that predictability premium, and we will come back to that.
On the top line, Rollins generated $3.74 billion in trailing 12-month revenue. Q1 2026 came in at $906 million, growing 10.2% year over year from the $823 million delivered in Q1 2025. That beat the analyst forecast of $895 million by 1.2%.
The organic versus acquisition breakdown matters here. Of that 10.2% total revenue growth, approximately 6.6% was organic, driven by pricing and volume. The remaining 3 to 4% came from acquisitions completed over the past 12 months. A 6.6% organic rate is within the historical 5 to 7% range that has powered the Rollins thesis for years. Holding that range is what the premium valuation requires.
Now let us talk about the bottom line, because this is where the quarter gets complicated. GAAP earnings per share came in at 22 cents, missing the analyst estimate of 23 cents by 1 penny. That is the first GAAP EPS miss in several quarters. Adjusted operating EPS came in at 24 cents, right in line with forecasts. The gap between GAAP and adjusted is almost entirely acquisition-related amortization, the accounting charge that flows through when you buy another company and write down the value of its customer relationships over time.
The margins are what make this business worth analyzing at a premium. Gross margin is 50.8%, strong for any labor-intensive services company. Operating margin is 16.1%. Net margin, including the acquisition amortization drag, runs around 14%. Return on equity is nearly 39%. For a company that is primarily people and trucks, these are exceptional quality metrics.
Cash flow is where Rollins truly shines. Operating cash flow on a trailing 12-month basis is approximately $600 million. Free cash flow, after the company's light capital expenditure requirements, pest control does not need semiconductor fabs or data centers, runs around $540 million. The company converts an unusually high percentage of net income into real cash.
The balance sheet carries about $1.04 billion in total debt, against $100 million in cash, leaving net debt of approximately $940 million. Leverage runs roughly 1.6 times EBITDA. For a recurring revenue business generating $600 million in annual operating cash flow, that leverage level is manageable and does not create near-term financial risk. The company has ample capacity to continue acquiring without straining the balance sheet.
Shareholders have been rewarded consistently through the dividend. Rollins pays a quarterly dividend of 18.25 cents per share, about 73 cents annually, for a dividend yield of 1.3% at today's price. The payout ratio is approximately 59% of GAAP earnings, The company has increased the dividend every year for over 20 consecutive years. That kind of consistency is part of what attracts long-duration quality investors to the stock.
Looking forward, the analyst community projects full-year 2026 revenue of approximately $4.1 billion, implying continued double-digit growth for the year. Adjusted EPS estimates for 2026 are around $1.24. 2027 projections run to $1.36. At $55, you are paying 44 times forward earnings. That is a meaningful premium to the broader market, even when you account for the earnings quality and growth consistency.
One more number before we move on. Book value per share is approximately $2.91, which means the stock trades at nearly 19 times book value. That gap between book value and market value is almost entirely the value of the Rollins customer relationships, brand equity, route density, and growth track record that do not appear on the balance sheet as hard assets.
The organic revenue growth rate is what sustains every premium metric on this list, so it becomes the single variable to watch. We will flag that as the key metric when we get to the bottom line. For now, the overall picture. Rollins' financial health is strong. Exceptional cash generation, durable margins, a proven recurring revenue model, and manageable leverage. The debate is not whether the business is good, it is whether the price is right.
Let me quickly add, the company has 281 million weighted average diluted shares outstanding. With trailing GAAP EPS of $1.10, the PE is 50 times. With trailing revenue of $3.74 billion, the PS is just over 7 times. Every angle of the valuation comes back to the same conclusion. You are paying a significant premium for a predictable business. Now let us see what the analysts who cover this thing for a living actually think.
Before we get to the street, I want to flag one data point from Q1. The adjusted operating EPS of 24 cents was exactly in line with the analyst estimate. So the miss was a GAAP accounting artifact, not a true operational shortfall. The underlying business performed where management said it would. That nuance matters for how investors interpret the quarterly result.
Fully agreed, Lana. And with that context in hand, let us hear from the professional money managers. What does Wall Street think about Rollins at $55? Among the 15 analysts tracking the stock, the picture is moderately positive. 9 rated a buy or outperform, 5 have it at hold, and 1 has a sell rating. The average price target is $66, implying approximately 20% upside from today's level. The range runs from a low of $50, barely above where we are, to a high of $72.
Stifel initiated coverage in January with a buy rating, which is notable because fresh initiations with buy ratings often signal that an analyst sees a specific catalyst on the horizon. Baird reiterated their outperform in February. Morgan Stanley kept equal weight in April following the Q1 results, which suggests they view the current setup as balanced rather than compelling. Oppenheimer and Goldman Sachs both maintained buy and outperform ratings following the Q1 report.
The bull case among the buy-rated analysts rests on 3 pillars. 1, the organic growth rate is holding in the historical range. 2, the recurring revenue model makes earnings highly predictable. And 3, the company has multiple levers to expand margins through route optimization and acquisition synergies. The target range of $66 to $72 implies the market will ultimately re-rate toward 55 to 60 times forward earnings as the thesis plays out.
The bears and the hold-rated analysts point to valuation as the primary constraint. At 50 times trailing earnings, the stock needs to execute perfectly to justify the current price. Any deceleration in organic growth, any margin compression from labor costs, or any softening in the acquisition pipeline would likely trigger a significant multiple contraction. The one sell-rated analyst argues that the family selling overhang and the GAAP EPS miss signal that the easy years of multiple expansion are behind us.
On the Q1 earnings call, management maintained full-year 2026 revenue growth guidance of 9 to 11%, with organic growth expected to continue in the 6 to 7% range. They flagged commercial pest control bookings as particularly strong and noted that residential pricing increases are flowing through at above 4% on average. No specific GAAP EPS guidance was provided, but the adjusted EPS trajectory is consistent with the $1.24 full-year estimate.
Bottom line from the street. The analyst community believes in the business quality, but the majority position is cautiously positive rather than aggressively bullish. The 20% upside to the average target is real, but it requires no slip in organic growth, no major labor cost surprise, and continued execution on the acquisition program. That is a lot of conditions to satisfy simultaneously when you are already priced for perfection.
Let me lay out the bull case for Rollins. The number one argument is the organic growth engine. 6.6% organic in Q1 is not spectacular, but it is consistent. If the summer pest season, which historically drives the highest volumes in Q2 and Q3, delivers above-trend performance, full-year organic growth could reach the upper end of guidance. That would signal the pricing power is intact and the thesis is on track.
The second bull argument is the moat quality. Orkin has a century of brand equity. The route density advantage takes years to replicate. Commercial pest control switching costs are high. Changing vendors means bringing in a new provider to learn your facility, reset traps, and audit baseline pest activity. Once a commercial customer is integrated into a Rollins service program, the economic friction of switching is significant.
Bull argument 3. The family selling overhang will clear. Once the Rollins Family Voting Trust completes its current liquidation program, the persistent technical selling pressure lifts. That creates a natural re-entry point for long-duration quality investors, the kind who have owned Rollins for 10 and 20 years and have been waiting for the family supply to clear before adding to positions.
Fourth bull argument: M&A synergy flow-through. Recent acquisitions integrating onto the Orkin and Home Team platforms should deliver margin improvement as acquired businesses adopt Rollins route density optimization and technology platforms. An operating margin expansion of 100 basis points from the current 16.1% level would add meaningfully to earnings without requiring any new revenue.
And the fifth bull argument is international optionality. Rollins operates in approximately 90 countries, but international revenue is still a modest percentage of total. If Gahlhoff's team can replicate the U.S. route density playbook in underpenetrated markets, Europe, Asia, Latin America, the long-duration growth runway extends well beyond what the domestic market alone can deliver. That option is not priced into the current multiple.
Now let me give you the bear case. The most acute risk is valuation compression. At 50 times trailing earnings, the market has priced in perfection. There is essentially no cushion for a bad quarter. One meaningful organic growth deceleration, say from 6.6% to 4.5%, would likely reset the PE toward 35 to 40 times, which translates to a stock price in the low 40s. That is more than 20% downside from today.
Bear argument 2, labor cost inflation. Pest control is an intensively people-powered business. Technicians are the product. And in the current labor market, competition for skilled hourly workers keeps wage pressure elevated. If technician wages rise faster than Rollins can pass price increases through to customers, operating margin compresses and the earnings growth that justifies the premium multiple starts to slow.
Third bear argument: the GAAP EPS miss in Q1 may not be entirely explained by amortization. Acquisition-related amortization is a real cash cost in the sense that it reflects value paid for acquired customer relationships. If Rollins continues acquiring at elevated multiples and amortization charges grow faster than revenue, the gap between adjusted and GAAP EPS will widen, and over time, investors who pay attention to GAAP will re-rate the stock lower.
Fourth bear argument, the family selling. $1.14 billion in shares sold by the founding trust is not a rounding error. It is the kind of selling that creates technical pressure regardless of business quality. And if the trust continues to sell in subsequent quarters, the stock will face a structural supply imbalance that is difficult to overcome even with strong operating results.
And the fifth risk is acquisition multiple creep. The pest control sector has attracted significant private equity attention over the past 5 years, driving up prices for regional operators. If Rollins is forced to pay higher and higher multiples to sustain its M&A growth contribution, the return on acquired capital will erode. and a pest control company paying private equity prices for growth is a very different investment than one executing an organic plus tuck-in strategy at disciplined multiples.
Okay, both cases are on the table. Let us move to how Rollins stacks up against its closest peers. On the peer side, the two most relevant benchmarks are Rentokil Initial and Cintas Corporation. Rentokil, ticker RTK, is the global pest control operation that now includes Terminix following its acquisition. Cintas, CTAS, is the diversified uniform and facility services compounder.
Rentokil trades at a price to sales of 1.7 times compared to Rollins at 7 times. That is a massive P/S gap. Rentokil's lower multiple reflects its integration execution risk from the Terminix deal, lower margins, and a less premium quality earnings profile. The comparison highlights exactly what the market is paying up for with Rollins, the recurring revenue quality and the demonstrated margin execution that Rentokil has yet to fully prove post-acquisition.
Cintas is the more interesting benchmark. It trades at 7.5 times sales, actually slightly above Rollins, with a PE of 40 times compared to Rollins at 50 times. Cintas is growing revenue at 8% annually, Rollins at 10%. Both companies earn premium multiples for their recurring service models, which validates the idea that the market genuinely pays up for this kind of business. But Rollins commands an additional 10 multiple points versus Cintas, which the bulls argue reflects pest control's higher switching costs and the Orkin brand premium.
The peer comparison frames the Rollins valuation debate clearly. Relative to Rentokil, Rollins looks expensive but arguably deserves the premium. Relative to Cintas, Rollins is also premium but within a range that quality investors have historically been willing to pay for the best-in-class operator in a recurring services niche. The question is whether the family selling and the GAAP EPS miss justify a discount to where the stock has historically traded.
Now let us talk about what the options market is pricing in and what has been happening on the insider front.
On the options side, implied volatility on Rollins sits near the 60th percentile of its historical range. That is elevated above the midpoint but not in panic territory. It reflects near-term uncertainty from the GAAP EPS miss, the scale of family trust selling, and broader questions about whether a 50 times earnings multiple is sustainable for a pest control company. The put-call ratio data is not publicly available for precise reporting here, but the positioning we can observe is cautious without being panicked.
Put activity has been clustering around the $50 and $52 strikes, investors hedging against multiple compression if Q2 organic growth disappoints or the family selling continues at the current pace. On the call side, open interest has built up around the $60 and $65 strikes, consistent with the average analyst price target of $66. The market is positioning for a recovery toward fair value, not pricing in a business breakdown.
Rollins' low beta of approximately 0.65 keeps absolute implied volatility structurally lower than the broader market, so the 60th percentile reading here still implies relatively contained expected price moves. This is not a high volatility speculative situation. It is a premium compounder whose near-term uncertainty is about valuation, not about whether the pest control business is working.
The options setup says the market is cautious but not scared, which makes sense given the underlying business quality.
Now let us talk about insider activity, which tells a very different story. Over the past 6 months, there have been 0 open market purchases by named executives or directors and approximately 20 sell transactions by the Rollins Family Voting Trust, totaling over $1.14 billion in share sales.
To be fair, the Rollins Family Voting Trust is not a typical insider selling event. This is a large family estate structure that has held a significant percentage of the company for generations. Sales from this trust can reflect estate planning, portfolio diversification, tax obligations, or trust mandate requirements, not necessarily a judgment that the stock is overvalued. But the scale is impossible to ignore. Over $1 billion removed from a company with a $26 billion market cap in 6 months is a real signal, even if its interpretation is ambiguous.
What the insider data does tell us clearly is this. No executive or director who is running the day-to-day business believes the current share price is such a compelling value that they are putting their own money in. Zero open market buys alongside over $1 billion in trust sales creates a lopsided picture. When evaluating any stock, alignment between management, insiders, and outside shareholders matters. Here, that alignment is incomplete.
Understood, Lana. The signal is worth watching, even if the interpretation is not as clean-cut as a traditional insider sell. Let us bring it all together. Let us bring it all together with the bottom line on Rollins. This is the world's largest pest control company, a business with genuinely durable competitive advantages, a proven recurring revenue model, and over 2 decades of consistent dividend growth. The Q1 2026 results showed the revenue engine is still running, 6.6% organic growth, a revenue beat, and management maintaining full-year guidance.
The complicating factors are real. The GAAP EPS miss is the first in recent memory and raises questions about acquisition amortization drag. The founding family's billion-dollar selling program creates technical overhang that is hard to dismiss, and the 50 times earnings valuation leaves essentially no room for any form of execution slip. The stock needs organic growth to hold, margins to expand, and the M&A program to generate returns, all simultaneously.
The key metric to watch, the single number that will tell you whether the Rollins thesis is intact or fraying, is the organic revenue growth rate. Watch Q2 and Q3 2026 organic growth. If it holds above 6.5%, the full-year guidance is achievable and the valuation is supportable. If it drops toward 5% or below, the premium multiple will compress and the stock will face meaningful downside from today's level.
Rollins has delivered for long-term shareholders through multiple economic cycles, recessions, pandemics, labor shocks. The recurring revenue model is genuinely resilient, but resilient does not mean immune to valuation math. At 50 times earnings, you need the business to be not just good, you need it to be good and cheap relative to its future. Right now, the market is debating whether the family selling and the EPS miss are one-time noise or the early signs of mean reversion in the multiple.
The closing thought Jerry Gahlhoff shared on the Q1 earnings call captures the Rollins ethos perfectly. The pest control industry is built on trust. Once a customer trusts you, they keep you. Our job is to earn that trust on every single service visit. That is not a financial model. That is a culture. And cultures that deliver on that kind of promise over decades, through good markets and bad, tend to be worth paying up for. The debate is just about how much.
Well said, Hudson. Watch the organic growth rate. That is your answer.
And hey, if you want to run the same research workflow we use to build these episodes, everything is free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I am Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.